So just a quick introduction. This is the advanced markets team at BMO Insurance. These are the people that sort of make me smart and look good. Suzanne is based in Montreal. She's our lawyer. Jackie's based in Vancouver. He's our business development manager, wholesaler for advanced markets. And Daniel Boloski works in Toronto head office with me as well. So between the four of us, whenever a BMO Insurance wholesaler, BDM, has any kind of inquiries that are a bit more technical, they will filter those questions through us, and one of us will kind of jump in and either answer the question directly or indirectly and sort of help move the large cases along. So this is the BMO Insurance Advanced Markets team. So the increasing need for corporate-owned life insurance. So I usually make a bad joke at this point about the current government and how they are technically have been very, very helpful to life insurance sales. They've sort of been a center of influence, so to speak, with some of the policies they've implemented in the last couple of years. So although our current leadership is maybe not particularly popular with the most Canadians, they're pretty popular in my books because they sort of help me with my targets. So I will talk a little bit more about why there is an increasing need for life insurance. Starting with the federal budget, this past budget that was back in the spring of this year, they introduced a few things. One of them was the Canadian Entrepreneur Initiative or Incentive. And this is actually a really great thing. So basically what they've done is they've introduced a lower capital gains inclusion rate. So only 1/3 would be taxable. And that's a really great thing to introduce. The problem is it's very limited to very specific sectors like technology or manufacturing. So it doesn't have a wide reach, but it's really trying to target a lot of the industries that Canada has lost over the years to competition from around the world, the BlackBerries, the Nortels and whatnot. So it's a good step in the direction, but this doesn't necessarily help a large portion of business owners. Therefore, it kind of helps us with life insurance sales because life insurance can do a lot more. Alternative minimum tax. So this was the AMT was increased from about 15 to 20.5% with 100% capital gains inclusion rate. So that's pretty punitive. And the AMT is really going to impact high net worth, ultra high net worth Canadians the most. So this is going to be something that I think to keep an eye out for, and this could help generate some more life insurance sales as well. The capital gains inclusion rate. So this one, there is going to go through some additional votes in the House of Commons this month. So you have to be mindful that this is not absolutely written in stone. It's probably going to happen unless the government falls. But effectively, what's going to happen is the capital gains inclusion rate is increasing from 50% to 66.7%. And so this impacts all corporations and it impacts most trusts. The difference is on the personal side, you have a threshold of $250,000. So up to the first 250, it's going to be the normal 50% inclusion rate. Anything above that is at the new 2/3 rate. But for corporations, it's all going to be 2/3. The capital dividend account. So that's another thing. So with the new budget, with the new inclusion rate, what's going to happen is only 1/3 of the non-taxable portion is going to be credited towards your CDA calculation. So what does this mean in plain English? Makes life insurance even better because the life insurance death benefit less your ACB is your CDA credit. So there's going to be more reason why you want to buy life insurance because you're going to get a better bang for the buck with the CDA with a life insurance policy. The small business deduction limit. So this was not from the recent budget. This was from the 2018 budget. But effectively, what's going to happen, or what is happening, is that the more passive income that's held within all the related companies, so you have your OpCo, HoldCo, InvestCo, Real Estate Co, and whatnot, the more passive income that is generated, what's going to happen is your OpCo their small business deduction limit is going to be impacted by that. And effectively, they're going to be taxed at a higher rate on their active income, their pre-tax operating income. And I'll expand a little bit more further on that. But when you add up all these four things, what does it basically mean? It's going to lower your estate value. And if you don't do any kind of a proper insurance planning, you will have a lower estate value as a result of the combination of all these things. So this table on the right is showing you the new marginal tax rates with the new capital gains inclusion rates. So for corporations in Ontario, it's going to increase from about 25% marginal tax rate to about 33%. And it's going to be roughly about, in that range, depending which province you're in. Of course, Alberta gets the best breaks across the Canada. And I guess the PEI gets hit the hardest. But this kind of leads you with some discussions as to the theory of integration and what do you do with your investments? And there's some talks about maybe potentially having more of your capital gains held personally and more of your other taxable investments held corporately. You wouldn't necessarily want to sell your investments to change the allocation, but as new monies flow in, whether it's personal or corporate, you may want to decide to rebalance your portfolio. Another point of discussion is that, the more interest income you're going to have inside your corporation or dividend income inside the corporation, what that's going to basically do is going to sort of make your life insurance sales even more attractive because the fact that the life insurance policy can keep a lot of that interest income and that dividend income exempt, tax sheltered or deferred, depending on the terminology you like to use. So we have a more in-depth article that Daniel Belaski wrote back in the spring of this past year. So there's a quick little QR code there, so you can just sort of like grab your phone, take a picture of it. But it is on our website. If you go to bmo.com/advisor and go to the forms database and look for budget 2024, you'll see this article. The article talks about insurance planning for individual, trusts, and corporations. So a lot of gems in there in terms of some things you can basically approach your clients with. So let's kind of jump into the main part of the presentation. What is the corporate asset transfer plan? Effectively, so other insurance companies will call it different names: corporate estate bond, corporate efficiency transfer, whatever you want to call it, whatever the marketing name you want to give it. Effectively, it's all the same concept, and all it's doing is increasing the after-tax value of the corporation for the shareholders' heirs. That's all we're effectively doing with this concept. What are the core objectives of this concept? First and foremost, provide insurance protection. You have to develop and establish an insurance need. Sheltering money is not a valid reason to buy life insurance. So when you're positioning stuff to underwriters, you have to clearly demonstrate and articulate why there's a life insurance need. Assuming you've got that out of the way, what are we going to do here with this concept? We're going to take your taxable surplus and move it into a non-taxable pot, all within the corporation. Still balance sheet asset. We're just moving from a taxable environment to a non-taxable environment. And by doing so, what are we going to do? We're going to increase the after-tax earnings. And how we do that is because we're going to have less passive income to report. Therefore, the clients are going to be at a lower tax rate in terms of their active income inside the corporation. And also what we're going to do, depending on how we structure and build the policies, we can actually potentially decrease the capital gains tax that they're going to be realized upon death of the shareholder. And I'll expand upon that. So these are the core objectives of the corporate asset transfer plan. So in terms of the passive income and its impact on the small business deduction limit, this graph kind of just summarizes it. On the x-axis is my passive income in all my related companies: OpCo, HoldCo, InvestCo, Real Estate Co, and whatnot. And on my y-axis is my small business deduction limit. So if all my corporations has passive income and it's $50,000 or less, the tax in my operating company is not going to be impacted or the small business deduction limit is not going to be impacted by the passive income that's being realized. So anything up to the first $500,000 will be taxed at 12%, and anything above that will be taxed at a higher rate, at 26%. But what happens is, as my active income grows within all my related companies, my operating company's taxation on the active income is going to increase. So once I get to the $150,000 threshold, my small business deduction limit goes down to zero. Therefore, all of that income, all of that active income or pre-tax operating income gets taxed at 26%. So if I look at sort of more detailed comparison here, assume we have a small business tax rate of 12% and the general rate at 26% rate, a 50% tax rate and 5% growth rate. We assume that if I take $100,000 of passive assets and remove that from the taxable portion of the balance sheet of my corporation and move it into the tax-free portion of my balance sheet within the corporation, i.e., a life insurance policy, what happens? In year one, I'm able to avoid about $5,000 of passive income. And in year one, I'm also able to prevent the reduction of a small business deduction limit of about roughly $25,000. And as a result, I save about $3,500 in year one. And so you fast forward out 30 years in the future, by being able to minimize the amount of passive income, I've saved this client, the theoretical client here, $1.2 million. That's quite a bit of tax savings just by being able to use a life insurance policy to fund this objective. Now, the next layer of taxation is going to be way at the back end when the client passes away. This is the deemed disposition of shares. This is the dreaded capital gains tax. So what's going to happen upon death of the shareholder, the fair market value in excess of the ACB is a capital gain. Now, under the old rules, the old inclusion rate, only half of that would be part of the calculation for the taxation you're going to pay. But under the new rules, assuming the government doesn't fall and all the final readings and the budgets pass and the votes happen this fall or this October, the inclusion rate goes up to 6.7%. And as a result, there's going to be a significant impact to the estate as a result of this new inclusion rate. And that tax is taxed at the client's normal marginal tax rate. So roughly 53% here in Ontario. So that's going to be a pretty significant hit. Another thing that's going to happen is when we calculate the fair market value of the shares of the corporation, you take into account any capital gains or losses of the shares, any alternative investments that are held inside the corporation, so like stocks and bonds and whatnot. But I also think another thing that happens is the cash surrender value is added to the fair market value of the shares of the corporation. So while the insurance policy gives you a tax-free death benefit, gives you CDA credit, and it gives you that tax-exempt growth over the life of the contract, what it also does is that cash value is going to increase the capital gains on the shares upon your death. So let's just do a really simplified example. Let's say they're twin brothers. The brother on the left has a GIC and it's worth 100,001. And then the brother on the right only has a life insurance policy inside his corporation. And it's $1 million life insurance policy to keep it simple. And the cash surrender value is $1. And we assume my ACB is $1 and the corporation only holds that one asset. So what's going to happen is when the brother on the left passes away, he's going to get a capital gains of $100,000. But his twin brother on the right, when he passes away, he's not going to have a capital gains tax because his cash surrender value is $1, his ACB is $1. So therefore, your capital gains is zero. So by having more of the right and less of the left, we effectively, in this example here, save the client $33,000 by doing this. So this is sort of a really simplified example of what we're trying to accomplish here, but this is the core message that we need to sort of be able to articulate to customers to make them understand the impact of this taxation. And now, when the client has passed away and they're all talking about, like, winding up the corporation and the distribution of the assets and how that goes to the heirs, these are the key events that are going to happen. The death benefit less your adjusted cost basis equals your CDA credit. The CDA credit is the portion that flows tax-free to the estate of the shareholder. Your ACB and the policy is effectively the taxable portion. So your ACB times your individual dividend tax rate, let's say 47% in Ontario, that's the net amount is going to be the portion that will flow to the estate of the shareholder. So it's the sum of those two pots. So as a result, if we can effectively lower the impact of the deemed disposition of the shares and increase the after-tax distribution of corporate assets, we can increase the overall estate value. So less on top, more on the bottom, basically translates to happier children and maybe a happier spouse upon the passing. So let's go through a case study now. That's sort of the background, and let's go through the case study now, and I'll walk you through some examples of how I would design and set up a policy and have these kinds of conversations with customers. So Sam and Sally, they're married, they're happy, they got lots of money, they got a holding company, They got like, roughly 2 million bucks sitting in there right about now. And their main objectives really here is to minimize the amount of taxes they're going to have to pay. And also they want to maximize how much money will go to their children. Less to Ottawa, more to their children is sort of the rationale. So we're going to deposit $100,000 in the policy for the next 10 years. And I'm going to use Alberta rates because I tend to default to Ontario rates because I remember them easier. So 48% corporate tax rate versus the 50.17 in Ontario. And the non-eligible dividend tax rates of 42% versus the 47% or so here in Ontario. My product of choice will be a joint last die policy because it's a husband and wife team, and there's not going to be any taxes, really, any major taxes triggered until second death because most of the assets, including the shares of the company, will roll over to her anyways. So I'm going to run two options here. I'm going to run a universal life policy. I'm going to put 100 grand for 10 years. I'm going to put it into the 10-year GIA account, and I'm going to run it at the contractual minimum of 1.5%, the guaranteed minimum. And I'll have the computer solve for the biggest death benefit it can buy for that based on that guaranteed rate. So effectively a guaranteed 10-pay solution, more or less. And then I'm going to run a current -1 illustration using our whole life policy. I always default to -1 because interest rates are coming down again and we're starting to get downward pressure again. So it's always best to err on the side of caution with a -1 at a minimum. So then what I'm going to do is I'm going to throw this into our product suitability spreadsheet. This is the internal spreadsheet that we use, our wholesalers or BDMs use, and I use as well. So if you want this kind of product suitability, we can run these kind of numbers for you. Just reach out to your wholesaler. So what I've done here, I've run three basically product configurations and I look at different points in time, right? So I've run a BMO UL, a wire to 8520 level death benefit, 1.5 GIA. We'll call this effectively a guaranteed 10-pay policy because it's all in the 1.5 GIA minimum. I'm running our guaranteed 10-pay whole life policy, and I picked the guaranteed 10-pay because that one illustrates the best in the long run versus our offset illustration. And I've thrown in our competitors' numbers in here as well. I've run their offset 10 illustration because their offset 10 illustrates better than their guarantee 10 pay. So I want to pick, my best versus their best is sort of the argument. And you see at age 90, when the second person passes away, they're all around $2.1 million, 2.14. So there's really no clear winner from the death benefit perspective. The difference here is going to be cash surrender values will be lower on my UL policy, which is the first product line, the Wire to 8520, because the way I've designed this policy is I want to have it to have decreasing cash value over time. So by the time I get to life expectancy, there's no more cash in the contract. It's a fully guaranteed paid up policy. Whereas the two whole life options basically has a lower cash value initially, and it kind of grows over time. And then each product will have a different ACB. Generally speaking, in older lives, a UL is going to have a better ACB grind than a whole life policy will. And from an estate value perspective, if you flush in your death benefit less your ACB, your CDA credit, plus the taxable portion of your dividend, you basically net around 1.9, 1.8. Again, no one really has there's no clear distinctive winner. Technically, company C, the competitor's whole life policy, beats out 1.96 versus 1.95 on our UL. But there's not really a clear winner at this point. And this is where all analysis typically ends with all companies' concepts, their equivalents to a corporate asset transfer plan. So I'm going to take it one step further, and we take it one step further with this comparative spreadsheet that we use. So because there's cash value in the life insurance policy, you have to factor in the additional capital gains tax that's going to be realized upon death. So you kind of see here at age 90, my UL solution has the lowest amount of capital gains tax owed, 200 grand, versus the whole life solution at the very bottom, which is around $685,000. So if you deduct those numbers from the previous slide, the 1.9-ish numbers, you really get closer to 1.75 for the UL or 1.29 or 1.28 for the two whole life options. So the key takeaway in this slide here is that how you design the life insurance policy really matters, and you shouldn't necessarily default to your standard illustration, which if I look at the LIMR data, the majority of the sales is whole life. And if you are in a sea of competition with other advisors and everyone is presenting the same whole life solutions, and you're the one guy that comes or gal that comes up with a UL solution where it has very nominal cash value of life expectancy, your number is going to stand out because 1.75 is much better than $1.2 million. So now that's the first case study. I'm going to do have a conversation on similar lines. In this example, I want to do a comparison of a 10 pay versus a 1 pay because this is something that's really worth looking at. So let's start off with my standard setup. I got a mail $70 million. Again, YRT 8520 level death benefit. I'm going to run my 10-year GIA at the contractual 1.5%. That's my option one solution. So the computer basically solves for how much premium is required to avoid lapse, and it comes back with $74,000 a year for 10 years. My option two is actually making one single deposit into the UL policy. I'm going to throw it into the 30-year GIA option in the policy and the side account because there is about 3 years worth of side account balance, but it's all going to get the same rate. So in this example, I ran at a 3% rate of return. Technically, it's 3.05 this week, but I'm running. I want to really run some rock solid guarantees here. And what you see, you fast forward to age 85, 15 years down the road. The single deposit gives you a much better net to estate value, a much better CDA credit because you put roughly $200,000 less into the insurance policy because you have a higher rate of return, the 3% versus the 1.5% GIA. So this becomes a much more interesting conversation because if the client has the money today, why pay it over 10 years? Why have that conversation with the client for the next 10 years about making that annual premium payment when you can just get one shot, get it done, get it over with? It's a much easier conversation. Sometimes having these annual checkups with some of the elderly clients that are approaching their mid 70s or beyond becomes a little bit difficult. So this is a nice, clean, simple transactional approach, fully guaranteed. This is basically lapse proof. Now, what I want to do now is I want to compare this to the alternative because I know what the alternative is just from my experience. So this is the single deposit UL illustration. It's $1 million all the way through. In the first couple of years, the death benefit grows because there is side account for 3 or 4 years. That's why it's growing. But once all the money flows into the policy, the extra growth falls back off, and you get $1 million all the way through. Now, I'm going to compare it to the solution, which I know most of the market is currently selling right now. It's going to be my competitor's whole life policy. It's going to be their life pay policy, offset 10. So in this example, I put $74,000 in it for 10 years, and it grows to about $1 million by age 80. So you can see off the bat, the UL had a much better death benefit right off the bat. And that's all at current scale. At -1, -2, you can kind of see here, it never catches up to the UL policy. So the question is, do you want a fully guaranteed $1 million death benefit all the way through? Or do you want to kind of stick with a whole life policy, which may happen, but it may not happen? And so at older ages, this is a 70-year-old, UL is the product of choice. I have done so many comparisons with older lives with whole life, and with mostly with UL, and the older you get, it becomes a very, very compelling product. And if I look at my CDA now, that's my CDA for my UL Quick Pay. This is the CDA for my traditional whole life policy at current scale, -1, -2. So do you want to take the risk with whole life, or do you want a fully guaranteed UL, one single shot, get it done and over with? That's the conversation. And I got about 5 minutes left, so I'm going to rip through the last case study here. So I've given you both options. I've kind of showed the pros and cons of both products, and I'm not saying do one or the other. Then the question is, well, could you do both? And well, yeah, you absolutely could. So let's look at our third example, male 60. And I'm picking older lives intentionally because this is where the UL's sweet spot is. The older the life is, the better UL tends to work for these kinds of comparisons. I wouldn't do these kinds of comparisons for a 40-year-old as an example. It won't be a good story. But in this example, they've got $1 million to fund an insurance solution. The client doesn't really need early cash value, but they want it. It gives them the warm and fuzzy feeling. Maybe the advisor is more comfortable selling an early cash value product. But technically they don't really need this money because they've budgeted. This is not, they're not going to use this for their lifetime. But I'm dealing with the market, and most of the market tends to sell early cash value whole life products. So option one is my competitor again. It'll be their life pay whole life policy, maximum deposits, offset 10, the wealth version, I think I mentioned that already. And then option two is the 50-50 approach. I'm going to take $500,000 and quick pay a UL policy with BMO Insurance, of course. And then I'm going to take the other 50,000 or the other $500,000 and I'm going to feed it into their whole life policy over the next 10 years. And let's just compare now and how does that all stack up? So I'll do a comparison at current scale. I don't like running anything at current scale, but in this example, I really wanted to kind of show you how compelling this looks. So if I run it at current and it looks good, then you know a -1, -2 is going to look even better. So this is their death benefit at current scale. This is the 100% solution going all with that product and nothing else. And this dotted yellow line is the cash surrender value of the policy. So it kind of grows over time. You see by roughly about age 68, 69, my premiums paid equals total cash values. And by age 100, there's no more insurance risk left because the cash value is equal to your death benefit. The question is like, do you really need that much cash at the back end? Because you know what's going to happen in the back end. It's that capital gains tax that you're going to have to pay, or your estate's going to have to pay. So now let's look at the 50-50 approach. Again, $500,000 single deposit UL with BMO Insurance, and the other half will be fed into their whole life policy, 50 grand over the next 10 years, same policy configuration. So you can see from a death benefit perspective, I have superior death benefit all the way through with the 50-50 solution. And that crossover point is roughly around age 90 or so, where the 100% solution starts to look better at current scale. Obviously at -1, -2, that's a different story. But this looks pretty compelling. And from a cash value perspective, this is how the 50-50 solution looks. So you can kind of see right off the bat in year one, I have really rich early cash value because I made a single deposit in the UL policy, and that's all cash. So that's all going to be balance sheet asset. So the client's not going to be, their balance sheet's not necessarily going to go down. And as time goes on, the cash value in my UL policy will decrease over time, and the cash value in the whole life policy will increase over time. But you kind of see here that if the client gives me $1 million, my cash value is pretty much always going to be north of $1 million, right? It's nothing. Nothing's gonna. It's the clients sort of, if they want to get their quote unquote money back, they can get their money back, so to speak. But what does that actually mean from a tax perspective? CDA perspective, the 100-100 solution. This is the additional capital gains tax they're going to pay if they go with the 100% solution all whole life. This is the 50-50 solution from a CDA perspective. You kind of see her at age 90 when they die right exactly as predicted. Same CDA number, the 50-50 versus the 100 solution. But the key difference here, you're only paying 400 grand in capital gains tax versus 800 grand in capital gains tax. So that's the big difference here. Put on this page, yeah. You guys say QR codes if you want.
Yeah, and the slides again will be made available to the participants, so they can get those QR codes from the slides when they get them. And we're also making a video of the presentation as well, so we will have that reference material.
Awesome.
The other thing we'll do is, Pierre, we'll get you to answer the questions that were posed during the chat at the end. So when you go backstage, you can actually directly answer those questions. Many of them are a specific answer to a specific question, not more of general. So rather than to take the time now for specific questions, you can actually answer those backstage when you go back.
Okay.
But that's fantastic. There's lots of meat there. Obviously, we need an hour. Again, like I said earlier in my earlier talk, was that these are short snippets just to get your interest in some of the particular aspects of the carriers, nuances of their product and the presentations. And I think that Pierre brought out some good points in terms of UL versus whole life. There are some spots where UL is a better choice than whole life. So that'll give you something to think about, as well as the risk in terms of the dividend performance versus guaranteed. So let's stop sharing your slides there, Pierre. And thanks very much for your help today.
Great. Thanks a lot. Appreciate it.